Welcome back. This is Retirement News Online. Well, a growing number of investors now believe that U.S. stocks are overvalued, creating the risk of a significant bear market coming sometime in the future. And this is according to research from Yale University's Robert Shiller. My guest is John Goodhue with APO Financial in Colorado. John, it's good to see you. Welcome back. Now, since 2009, equities have tripled in value. Are you one of those on the bubble bandwagon?
Well, yes, absolutely. And it's really not a bandwagon. When you understand anything from a historical perspective, I'm a big history buff. We look at the market, for example, and the only thing we really have to go back to, say, 1900 is the Dow, because the NASDAQ wasn't created then, and neither was the S&P, but the Dow was around. If you go back to 1900, we've had 22 market collapses. They've happened every 5 to 6 years, just like clockwork. We've never had 7 years of a consecutive up market. And the drop in each one of those 22 times is averaged 37.5%. Today, we are at about 6.5 years. So we are overdue for a next market collapse. And we believe that since historically it's happened 22 times every 5 to 6 years, it's due now. And so yes, absolutely, it is time for this to happen.
Well, John, so the Fed is still delaying an increase in interest rates, probably because of the fear of creating another recession. Let's talk about treasuries.
Well, treasuries are safe. That's the only asset class really in 2008 that didn't take a big tumble. Other types of bonds are not that safe. People, they think of bonds as safety, and you've got to break out the different types of bonds. Treasuries are just one type of bonds, and yes, they're safe. But other bonds, like in 2008, the general bond class, except for treasuries, dropped 37%. That's not safety. And right now, we have bonds that have been dropping. The whole overall bond market's been dropping for the last 9 months or so. And so we're seeing a lot of weakness in bonds. We've got the lowest rates in history right now. And so we don't believe that bonds necessarily are a safety mechanism.
Well, John, it's no secret that right now CDs and bond yields are delivering next to nothing. Talk about where you can go for safety and some growth now.
Sure. I mean, we do both the insurance side products with our investment products. The products that we like the best for safety and reasonable growth are what are called fixed indexed annuities. A fixed index annuity is a fairly simple product. You basically can't have any market losses, but you can have a portion of market gains as the market has gains. You can also create guaranteed income for the rest of your life if you would like to do that with them. We like them because they're simple, they have guarantees to them, and we can create income for people.
Well, finally, John, there have been some recent innovations that actually make these products even more attractive. Can you talk about that?
Sure. I mean, one of the biggest new innovations with fixed index annuities, for example, are really having uncapped strategies, which just means that you can have a lot of growth that are market linked within a guaranteed product that you can't have any losses in. That's probably one of the biggest innovations over the past 5 years with fixed index annuities. So they're not a stock market product. They aren't a security. They're an insurance product, but they can gain an awful lot of good growth and still, again, have guaranteed income as a component of the overall product. So that fits really well within people's retirement plans.
Great, John. Thanks for sharing your time with us again today.
Thank you.
That was John Goodhue at APO Financial in Colorado, and this is Retirement News Online. Thanks for watching.